Really excited about the content. In kind of joking fashion, I thought the title should be Bond, Estate Bond, after our good friend James Bond. So hopefully you get that pun. But we're going to jump into the content today. Part of the presentation that we're chatting about today is really built off of a presentation that you saw or may have seen on January 18th. And that was done by Ian Taylor. Ian Taylor is a colleague of mine who runs our advanced concepts team. So he would be the individual that would help run things like a corporate estate bond if needed, corporate IRP, IFAs, things of that nature. So I'm going to touch on just what he had highlighted to set the stage for our presentation today. Then we'll talk about what an estate bond is, how it works, and we'll provide you some examples of both a personal estate bond and a corporate estate bond. So if you're not familiar with the concept, hopefully today provides you with some knowledge on that front. But this is something that I would strongly encourage you to reach out to your wholesaler about and have further discussion too. So before jumping into that, I wanted to provide you with a little bit of a primer on Vitality Plus. So Vitality Plus is a program that we now offer on our term products. It's available on our UL products, which I'm going to talk to you about towards the end of the presentation. In simple terms, this is really an opportunity for clients to get rewarded for making healthy decisions. And so before I talk about this offer, I just will highlight something that I thought was really cool and resonates with many people. And Vitality has been around in Canada for a number of years. But we've had tremendous success in other countries globally. So Vitality is not Manulife, it's a third party. We partner with them because they are a leader in behavioral economics. They do an excellent job of helping people make good decisions. And so we're very happy that last fall we were able to double down on that bet. We added it to our permanent product, the Manulife UL that I shared, and we should have it on our PAR product very soon. But in short, the goal with Vitality is to help people live longer, healthier lives. And so our partners in John Hancock, so this isn't yet available in Canada. I want to be clear, it's not here yet, but I think it demonstrates the value of Vitality and certainly articulates exactly what we're trying to do. And so in the United States, they have a partnership with Grail. And Grail is a service that normally costs $950, and they can pre-screen for cancers, over 50 types of different cancers. And so that service is now available to many Vitality members in the United States at no cost. And so while you can maybe argue that wearing a Fitbit or an Apple Watch or meditating or getting Expedia reward may not be something that your client's interested in, I truly believe, and I say this with absolute conviction, that if you want your clients to have the best life insurance experience and live a healthier life, you should be looking at Manulife Vitality, because eventually we will have a program similar to Grail and we will save lives in doing that. And I think that's such a cool message as an advisor to be able to share in a world where we often talk about morbidity and difficult conversations about death and critical illness. This is all of those things, but with a healthy and positive spin in helping your clients live a better life. So to that end, we wanted to make it easy for advisors and Manulife employees. So if you have a Manulife employee as a client or you're an advisor who needs insurance, you can now get term insurance with Vitality Plus, and we'll offer you a 1-year age setback, so a discount of sorts, and we'll also waive the Vitality fee for the life of the policy. So that's a substantial savings. And we know that it's the best way for you to familiarize yourself with this program and then ultimately educate your clients. So we've done our best to make this an attractive offer for you, and hopefully something that some of you on the line consider if you need insurance or you bump into a Manulife employee who's looking for insurance. So eligibility details, it's only on your life or that individual employee's life. The applications are accepted all the way until November 13th of this year, and it's available on Family Term with Vitality Plus, so not available on our UL product, unfortunately, with respect to this offer. Vitality is, but not this incentive. In addition, we will have the opportunity for people to potentially get one of these bundles. So there's a chance to win one of 15 health bundles. the latest Apple Watch, some AirPods, as well as a $250 Apple gift card. So some pretty slick stuff there. So if you're settling policies with us up until April 30th of this year, you will become eligible for this promo, and a pretty rich one at that. You could choose to keep it yourself. You could re-gift it to your family and friends, or perhaps a client might benefit from some of this stuff too. So I'll leave that with you to decide. But again, just a cool opportunity to get rewarded with Manulife. So our why, I think you heard me talk about this, but at Manulife, we fundamentally believe that we should help our clients and customers live longer, healthier, and better lives. And what better way to demonstrate that than the experience that I mentioned to you with Grail? There's so many components in the Canadian marketplace as well that demonstrate this exact mission statement. And it makes me really proud to be able to get behind this. And so although my skiing incident this week will keep me off the slopes for a little while, I was really lucky. Last week, I got out a number of advisors on the slopes, and it was just a great example of us doing that and meeting, but also enjoying ourselves and having some exercise and living a healthy life. So pretty simple stuff. It doesn't mean that you have to be in the gym every day, but just making some conscious decisions to either eat something that's a little bit healthier, or get your body moving, which we know has a really positive impact on individuals' well-being. So what's the misperception? Well, Manulife Vitality is not a rewards and loyalty program, nor is it a product. It's a wellness program. And so we really want folks to get that message loud and clear. It obviously provides rewards, and there is benefits to doing that, but it's not a product or a loyalty program in and of itself. It very much is a wellness program. And so part of the messaging that I'm sharing with advisors is your client, for example, probably subscribes to something like Spotify. They might subscribe to something like Amazon Prime. There's a million different subscriptions out there that people pay $10, $15 for. I have a young child, as you know, so I've got Disney Plus as well. And I think that's another $15 a month. Vitality is $6 a month. So for $6 a month, would your clients be interested in all of the benefits that come with that program? And I think if you were to position it that way to your client, most of them would absolutely say yes. And so I would encourage you to do that. If you're not familiar with this offering, today's presentation is not going to get into Vitality in any big detail, but I would encourage you to reach out to your wholesaler and learn more, because I believe it's going to be our big differentiator in years to come. So a couple of quick things that I wanted to highlight for you, because we're talking about estate bonds today. The estate bond concept is built on a permanent insurance solution. So we have two kind of leading permanent solutions that generally lend themselves to the corporate or personal estate bond. One of them is Manulife UL. So I talked to you about Manulife UL. You can add Vitality to it. It's our flagship universal life product. We have a level cost to 100 and a YRT 8520. Performax Gold Investment Account is one of those advantages in that product. That is effectively like a Manulife managed account. It's similar to our par fund in terms of the asset mix. It has a 1% minimum guarantee. The yield is smooth and it provides low volatility. So for those advisors out there who maybe aren't selling UL because they don't want to manage the investments, we can address that really easily. You could put the funds into the Performax Gold Investment Fund. We've got some good historical information on that fund, so you can make a conservative estimate on what it might return. And then we could look at using that for your client's insurance needs. Part two, if you have a client who wants to overfund UL, Manulife UL is the place to do that, because we provide a 1% rate enhancement on managed accounts and 20.25% on bond accounts. So for those individuals who are looking to overfund in a UL product, I would argue this is the place to do it. If you think about a mutual fund, for example, an equity-based mutual fund, let's just assume it's Fidelity as an example. If you buy that fund within Manulife UL, you will get 1% better performance than if you bought the exact same fund in a TFSA, for example. So the idea here is that we really are providing a 1% lift to those individual funds within our product. We've got low fees. So fees are something that you hear about, whether you're talking about universal life or whether you flip on the television set and you see Questrade or Wealthsimple or any of those folks, they're constantly talking about fees. So being able to talk to your client about a low fee environment for investing is paramount in today's world. There's no UL fee on managed accounts, and there's low fees on index and guaranteed investment accounts. And then number 4, we've got plenty of options for investment options. These are not limited just to Manulife funds. There's a wide variety of funds from all the large manufacturers. So something that you should be aware of, and certainly a product that we're quite proud of and we know has a competitive edge in the UL marketplace. Part 2 of that conversation, and the other product that we often see used with an estate bond concept, is Manulife Par. So Manulife Par is our flagship participating whole life product. It's excellent for estate planning, building a legacy, and managing a growing tax liability over time. You can leverage the cash value with this product. Obviously, you can use it as collateral for a bank loan, whether you're doing an IRP or an IFA. One thing that I will share with you on that front is that later this year, we should have the launch of our early cash value Manulife Par product. So for those of you that are in this space and are working with Par in a leveraged environment, you'll be excited to hear that we're going to have our own version of an early cash value product later this year. Great asset diversification, 60-40 mix, low volatility, of course, and it's tax sheltered growth. The one thing that I like to highlight with Manulife Par is our deposit option flexibility. We have the most flexible deposit option or additional deposit option, ADO, many refer to it as, in the marketplace. What I mean by that, first and foremost, we provide an automatic limit to everyone who applies for Manulife Par. So just at baseline, that provides a little bit of an advantage. You don't have to illustrate it. Even if your client doesn't illustrate it, they're going to have an automatic limit, which is really neat. And that never expires. So even if you choose not to use it for 5 years, that option will be available to them. There are some administrative rules in terms of what you can do each year, but a tremendous amount of flexibility there, which we're quite proud of. There's a built-in disability benefit. So if your client experiences a disability and meets the definition of total disability under our contract, they could access up to the entire cash surrender value without any tax implications. If that's not in the product, you would be taxed on anything over ACV, as many of you likely know. Really cool feature if you have rated clients. So you apply with another carrier, unfortunately, you didn't apply with us first, you get a rating. It's worth considering Manulife in that situation. We'd like to be your first choice, but in those situations, it's good to be mindful of Manulife because paid up and deposit option insurance is not rated. So we look really good on rated cases. And the other thing that we did last April is we guaranteed the purchase rates for paid up and deposit option insurance. So that's something that probably requires a little bit of conversation with your wholesaler in order to understand it to its fullest. But in short, if you think about a dividend that gets spit out, maybe it's $1,000 and it's buying paid up additions. In many instances, that paid up addition would buy, let's say, 5 units. So it's $200 per unit. But we've guaranteed that each year, they're kind of like YRT rates, that cost would be fixed, and that's in the contract now. With every other carrier in the marketplace, that is not guaranteed. And so in theory, that cost could go up to $250. So although you're getting the same dividend, your cost of paid up additions have gone up, and now you're only able to buy 4 units instead of the 5 originally. So hopefully that additional guarantee leads to more predictable results and less opportunity for the insurance company to change things so that the outcome isn't as illustrated. So this is a quick snapshot from Ian's presentation. So for those of you that saw it on the 18th, the whole idea here is that instead of buying life insurance, the client uses insurance premiums to buy a taxable investment that earns interest income. And so the question then becomes, what rate of return would a taxable investment need to earn to provide the same $1 million at life expectancy. So that's something that you got to think about conceptually. But today, in this particular example, we knew that this individual would need an 8% return in order to get $1 million at age 84. So it's the idea that this is what life insurance will provide at life expectancy. We're all really comfortable with that conversation. We do a good job of having that with our clients. But what would they need to do on that alternative investment? In this case, it's 8% to have that same $1 million payout at life expectancy or when that individual may pass. So the other thing that I wanted to highlight from Ian's presentation that he did an excellent job of covering is our current tax environment. So on the left side, you can see these are our personal tax rates. Many of us would be familiar with these. These are the rates that we're paying. Of course, I understand this is a national webinar, so it varies by province. In the case of Ontario, that highest marginal tax rate is 53%, a little bit more than that actually, but that could vary in other provinces. But those rates have really just gone up over the last 10 to 15 years and will likely continue to do so in the next little while as well. Conversely, corporate tax rates have done the opposite and they've continued to go down. And so if you think about that small business rate, it's as low as 12% or 9%, excuse me, 9 to 12%. And that provides an attractive environment for businesses to continue to reinvest in themselves and keep money in the corporation. Active business income, so over that $500,000 threshold, you're going to see a small jump. In Ontario, generally, it's about 26.5. But again, still a favorable tax treatment within the corporation when comparing it to personal tax rates. So when you think about that, we've got a corporation, we'll say, or we'll say Dan De Silva Corp, and I've got $1 million in the corporation, and that was taxed at 12.2% and then 26.5%. So relatively modest tax rates. If I were to take that personally, I'd be taxed at 53%. So if you don't need that money today, you're going to leave it in the corporation. And so this tax environment has resulted in increased corporate retention. And so there's a whole story there. And obviously there's some rules around passive income, which again, we've created this environment where people are going to house money in their corporations. But if you end up earning a significant amount of passive income, it actually grinds away at that small business deduction that we talked about, and you might end up paying at the highest tax rate within a corporation. So there's kind of two things happening here. We've got this tax environment that encourages us to keep it in the corporation, but we're saying now if you invest and you're earning a bunch of passive income, eventually we will grind down that opportunity to get reduced rates, which has obviously a cost associated with it. And so what becomes the solution in many cases is something like life insurance or corporately owned life insurance, because it's not treated as a passive asset. And we'll talk a little bit about that today. But that was kind of the story that Ian painted and sets us up for a conversation around estate bonds today. So what do we know about the taxation of corporate owned life insurance? The cash value of the policy is treated as a passive asset. So the CSV is treated as a passive asset. The cash value is included in value of the corporation on deemed disposition of shares at death. This one's the best part. The death benefit minus the ACB results in a credit to the CDA. And the CDA allows the corporation to pay out funds to shareholders as a tax-free capital dividend. And this is a significant benefit, which you'll hear us talk about a number of times today. So what's the secret? How do we address all of this and how do we make it happen? Well, the corporate estate bond is one example, and it really helps support the sales process. It's not a particularly complicated concept, but it's one that leads to an overwhelming majority of our permanent insurance sales. It demonstrates the advantage of the CDA for the benefit of the family members. It also addresses that tax deferral issue, and it supports discussions with the client's professional advisor or accountant. For me, I've been doing this for a number of years now, and I always think it's important whenever you're dealing with a large case, whether personal or corporate, to involve the client's accountant. The few times that I see personal or corporate insurance fall off the books or lapse, is often because the accountant wasn't involved, and then at some point in time, let's call it a year later, they become aware of it, they're doing the books, and they go, oh my goodness, what is this $50,000 life insurance premium? And for whatever reason, they may not understand it, or they may not agree with the solution. And so that client may follow the advice of their accountant and terminate that policy. So really important to have those folks on side early on, because if you do, I'm really confident it'll be sticky and it sets you up for greater success long-term. So what is the estate bond? Let's simply identify what that is. In my opinion, it really answers the question of, should I insure or should I invest? It's a personalized comparison of life insurance to a non-registered investment. So we're going to compare life insurance to an investment that's non-registered, meaning it's going to be exposed to tax. Or a little bit more verbose, a personal financial planning strategy designed to increase the size of your client's estate by repositioning surplus cash exposed to tax into a tax-deferred life insurance policy. So a few different ways to ask or answer the question, but in short summary, that's exactly what an estate bond is. Whether you choose to do it corporately or personally, there'll be a few different things that change, but to a large degree, these are the questions that you're going to be answering. So there's 5 pools of capital, and I want you to think about that in terms of what we're talking about today. So many of us are familiar with the registered pools of capital. We've got our RRSPs and our RIFs. Those obviously have contribution limits. They provide tax deferred growth. However, they are taxed on withdrawal. You've got the TFSA with your annual contribution limit, the tax-free growth and withdrawal. And then of course, you've got your pension registered assets as well. And you can see how these are addressed from an estate perspective. And then today we're going to be looking on the right side of the equation. So everything in green, we're going to be talking about. So the open investments or the non-registered investments could include things like interest, dividends, capital gains. Those are kind of the tax treatment that those investments would normally be exposed to. For the purposes of our discussion today, we're only dealing with interest-bearing investments. The tax treatment of those on death, the income and realized gains are taxed in the year earned. And then, of course, some of those deferred capital gains will be taxed upon death. But more importantly, we have this other non-registered asset class, exempt life insurance, which all of us are familiar with, but this will set us up for the conversation today. In cases, these have higher annual limits, they provide tax deferred growth, and they're obviously very estate friendly in terms of their tax, because you can name a beneficiary and bypass probate and all of those other estate settlement processes. So the idea today is to consider clients that might have a significant amount of money in that non-registered category or those open investments. And we're going to consider repositioning some of that into an exempt life insurance policy. So what are the benefits of the estate bond? So in my world, I think it's always important to communicate, why does this matter? What's important about it? Well, first and foremost, like any life insurance, it provides a large and immediate estate value. So if you think about a situation where your client was putting $30,000 into a non-registered investment, let's just say it was a GIC and they want to do that every year, and it's year 1. If they pass, they're going to have $30,000 approximately, plus whatever interest they received, and that would be what they have. In the case of life insurance, that $30,000 may have secured $1 million of death benefit. And so if they were to pass in year 1, you have that immediate large estate value. Of course, tax-free maturity value at death. There's tax sheltered growth of the cash value. Can reduce the tax payable while living. So there's that whole idea of taking your non-registered investments, which are being exposed to tax, putting it into a tax sheltered environment. And that will, of course, reduce your tax payable. It reduces the estate settlement costs. So things like probate, as I mentioned earlier, has the potential for creditor protection. And of course, the beauty of it all is in some cases, if there's cash value, your client would have access to that if they need it and they are looking for a contingency plan. So how does it work? Well, we need to get permanent insurance. We need to contribute to it annually or monthly. We know it'll be tax sheltered. We know that'll provide a tax-free benefit to the beneficiaries. We want to run a very similar comparison with the same amount being contributed annually or monthly to that non-registered investment. We want to demonstrate how it's going to be taxed, and then we want to compare them. So we're going to, step one, put equal contributions to insurance and non-registered investments. We want these to look very similar. We want to put the same amount of money here and the same amount of money here. We want to understand what's the net estate benefit over time. So what's the value to the estate, or what is that estate going to look like at different points in time? And of course, net estate values of the insurance are compared to an alternative taxable investment, assuming the same amount of funding at life expectancy. So the one point in time that we're going to really focus on is life expectancy. Nobody knows when your client's going to pass, of course. But the cool thing about this concept is that if it were to happen earlier, it only improves the story for life insurance. So we use life expectancy as a reasonable estimate. Of course, if they live longer, there's still a really good story there, but we have to pick a point in time for purposes of our comparison. So first, let's talk about a personal estate bond. So in this case, I'd like you to think about individual clients who want to fund estate liabilities tax efficiently. So those liabilities could be a number of things. Maybe those individuals have a number of investment properties that they know will incur a sizable tax when they pass away. And so they might be interested in that. Perhaps these individuals want to donate to charity. There's a whole other conversation around charitable giving and life insurance, which we won't get in today, but it is something that the clients might be interested in, and this can help them understand the benefit of using life insurance to do that. Or quite often, folks just want to pass funds to the next generation. And so perhaps that is their aim, is just to pass funds on to the next generation, and life insurance allows them to do that generally in the most efficient way. So the individual is going to be the owner of this policy. The individual will pay for the policy with after-tax dollars, like we always know, and they'll name beneficiaries to avoid probate. So we're going to take a quick example here, and we're going to look at Mrs. Karen Smith, 61-year-old female in the highest marginal tax rate. So that's going to be important. Tax rates do have an impact on how this looks. So generally speaking, you want folks who are in a higher tax bracket and have a number of assets, generally non-registered, to put towards a strategy like this. Karen was a successful CEO, but has since retired, and she has a desire to optimize her estate values and leave the largest possible inheritance to her children. So this sets the stage for an estate bond. And so in this case, what we're going to do is we're going to deploy Manulife Par. And so we're going to compare Manulife Par, $500,000 is the initial face amount. We want to compare that to a GIC earning 6%. And so an individual at this age, the volatility in the market, there's a lot of clients like this, they've got excess capital, but they're not interested in putting in equities because they want to preserve their capital. And so they're looking at something like a GIC. So in this particular case, we're going to assume that Karen could either put $37,631 into a life insurance policy, which is Manulife Par, or they could put the exact same amount of money into a GIC earning 6%. In this particular example, the dividend scale is current. I would encourage you to look at current -1 as well. We've assumed highest marginal tax rate of 53.53. So again, in this case, Karen must have a very sizable pension because there's a substantial amount of income still, and she's in the highest tax bracket. So let's see how this looks. And if you take a look at this, you can see that the net estate values over time for the life insurance compared to the alternative investment are substantial. So again, remembering, we're putting the same amount of money in both of these strategies. They just have different attributes. One's going to be exposed to tax. The other one's not going to be exposed to tax. And you can see the green line, or the life insurance in this case, far outperforms that alternative investment. And if we look out towards Karen's life expectancy, we know that the life insurance would actually provide a little over $1 million in death benefit, whereas the alternative investment would have only reached $700,000. So an interesting comparison, but there's no question the life insurance far outperforms the alternative investment. And if we want to look at it, some clients really understand internal rates of return, and the life insurance has an internal rate of return, of 4.68, whereas the alternative investment has an internal rate of return of only 2.79. So again, we know that it was a 6% GIC, but unfortunately it was being exposed to tax, and this client was at a 53% tax rate. So that lines up with our assumptions there. So in this case, it's really easy, right? The estate bond has such a complicated name, sounds a little bit confusing, but in simplicity, all we're doing is comparing life insurance to an alternative investment. And in this case, I think it does an excellent job of helping the client understand that this could be a viable option for them to increase their net estate values. And in doing so, they would have an additional $362,000 of life expectancy to leave to their heirs. So a really powerful message that I think would resonate with most clients. And this is something that often their accountant would understand as well. So one of the things that I like to do with our concept team, and you can't do it on the software yourself, so you do need to ask for this, I like to try and understand, what does that alternative investment need to earn in order to equal the life insurance at life expectancy? And so in this particular case, they were able to solve it for me, and they identified that the GIC would actually have to earn 10.08%. So let's call it 10%. In that case, the individual would need to earn 10% throughout the duration of this strategy. And so in this case, we know that they are 61 and life expectancy was in year 27. So that's a long time to secure a GIC at 10%. So probably not super likely that you're going to be able to do that. And as many of you know, the sequence of returns becomes increasingly important. And so if for whatever reason, 1 year they only got 7%, then they would not match the life insurance. So this is a really compelling way to help clients understand the power of life insurance, because when we're talking about it and we're comparing it, sometimes it can be tricky because we've just picked 6% out of the air. You can obviously tie it to current rates and create an educated example there. But when you actually say, look, here's what the life insurance would do, and here's what you would need to get from your GICs, that paints a really clear picture for the client in terms of the power of life insurance. So you can see here, this again is pulled from the estate bond presentation, that out towards life expectancy now, we do have these two situations equal to one another. And just keeping in mind that in order for us to achieve this on the right side, which was the GIC, it needed to earn 10.08%. So that summarizes in a lot of ways the personal estate bond. It's not particularly complex, but it helps provide a presentation to the client that demonstrates the power of life insurance and the relative tax efficiency that it creates. And so if a client meets some of those criteria that we talked about earlier, and they're looking to optimize their estate values, think about the corporate estate bond. Rather than just showing them a Manulife par illustration, you could create this concept. Your wholesaler would be happy to help you with that, and it will provide a nice lift to your sales presentation and conversation with the client. So switching gears a little bit here, I want you to think about corporate clients who have accumulated investable assets in the corp. So we talked about that earlier. There's a tax environment today with relatively favorable tax rates in the corporation. There is an incentive or a benefit to leaving assets in the corporation until you need them. Because of that low tax rate, provides opportunities for some of that money to accumulate. They want, similarly to the personal client, to fund estate liabilities tax efficiently, and they want to distribute funds from their corp at death. So this, in a lot of ways, some of the language that I like to use is this is a way to recharacterize accumulated investable assets and recharacterize them as capital dividend and have them extracted in a tax efficient manner. So the corporate estate bond is a financial planning strategy designed to increase the size of your client's estate by repositioning surplus corporate dollars exposed to tax into a tax-deferred life insurance policy, or reposition that surplus corporate dollars into capital dividend account, which, as we know, allows you to get the money out of the corporation tax-free. So what are the benefits of a corporate estate bond? Similar to our personal estate bond, it will provide a large and immediate estate value. So of course, we've got the insurance tied to this. So although you're paying a relatively small amount in year one, if the unthinkable happens, it provides a substantial number immediately. It provides tax sheltered growth of cash value, reduces the tax payable by the corporation. So if you think about what we talked about earlier, some of those passive assets in the corporation can have a grind on your small business deduction. And so by repositioning some of those investments into a life insurance strategy, you could reduce that tax payable by the corp. The insurance proceeds are received tax-free by the corporation, and they generate a credit to the corporation's CDA. If that's something that you're not familiar with, I would strongly encourage you to spend some time with your wholesaler and familiarize yourself with it, because in my opinion, it's absolutely the best advantage, of having permanent insurance, or any insurance for that matter, in a corporation. It enables tax-free distribution to the deceased shareholder's estate. And of course, if they need it, they have access to cash value. So many of these attributes should be very similar and familiar to what we talked about on the personal estate bond side of things. However, we have this additional opportunity where we can use the capital dividend account, because if that didn't exist and you had $1 million paid into a corporation, you'd have to pay dividend tax rates on the way out, which would be quite punitive. So having the opportunity to have $1 million paid into the corporation and then take almost all of it, in most cases, out tax-free is a tremendous advantage to those business owners. So the ideal client profile. We're thinking about shareholders of a private Canadian corporation, often aged 45 and older, in good health. Corporation, as we talked about, has surplus funds available to invest. That investment income is probably being taxed at the highest corporate tax rate. Those of you that aren't familiar, in Ontario, that highest tax rate for corporate investment income is 50.17. So very, very punitive. They have a desire to leave a legacy at death. And of course, these folks are receptive to long-term planning strategies. So how does it work? The corporation purchases, and overfunds an exempt life insurance policy. The shareholder is the life insured, and the corporation is named as the beneficiary. That's very important. You do not want the shareholder to be the beneficiary. You want the shareholder, of course, to be the insured, but the corporation will be the beneficiary. And that's effectively how we generate that credit, that CDA credit that we've been talking about. Cash values accumulate on a tax-deferred basis, increasing the death benefit payable under the policy. And then, of course, at death, the corporation receives the insurance proceeds tax-free. The corporation will receive a credit to its CDA. And of course, that CDA is really insurance proceeds less the policy's ACB. So when you heard me say most of it would come to you tax-free, the kind of caveat to that is death benefit minus ACB. So whatever the ACB is, you'll have to dividend that remaining amount out. But as we all know, that ACB can grind down towards zero out at life expectancy, which again, beyond the scope of today's conversation, but will be part of the analysis when you're choosing different products. They have different outcomes for CDA. Tax-free capital dividend is paid to the client's estate, and the insurance solution, again, is compared to a corporate-owned taxable investment. So let's take a look at our first example. And so our first example here, we're going to use Manulife UL. You'll understand why we're using Manulife UL in a moment. But in this particular situation, we've got a male 63 non-smoker, and they're going to pay little over 26, or I guess close to $27,000 into the exempt life insurance policy. So you'll notice that I've outlined all of these different categories in different colors. So this is pulled from the estate bond presentation that you can get. It's very much like an illustration, but it can be overwhelming for you and the client when you first see it. These colorful boxes don't exist on the illustration. And so I wanted to highlight at the top there, that's where I always start. And that gives you just the framework in terms of what are the assumptions that we've made. So we know the client's age, we know they're a non-smoker, we know the initial deposit, and we know the initial death benefit. We also know the tax rates that are being used. That's really important because they drive a lot of what happens in the estate bond. If that corporate tax rate was 12%, for example, this would not look nearly as attractive. So you do want clients that are being exposed to high tax rates. And in this case, we're going to compare it to an interest-bearing investment or a GIC at 5%. So on the left-hand side in the gray box, that should be familiar to you. That's exactly what we would see on a traditional life insurance illustration. The only exception to that is that we have two more columns. We've got our CDA credit. So in year one, as an example, you can see the total death benefit is $1 million. And we know that the annual deposit is 26, almost 27,000. And so your ACV would be very close to that. And the CDA credit ends up being 975,000. So that 975 is the amount that you would be able to take out of the corporation tax-free. So in this case, the only thing that would be exposed to tax is the difference between 975 and $1 million, relatively small amount. And that's how you derive that net estate value of 988. So a fairly tax efficient way to get that $1 million out of the corporation. And what we want to do is we want to compare the same amount of money going into an alternative investment that, of course, is going to be exposed to tax. And in this particular case, we know that that can be quite punitive, and it doesn't lend itself to a very effective way to grow your assets. So when we look out towards life expectancy, which is what we always do with an estate bond, you can see that out towards life expectancy, the net estate value on this particular product is 925. So you can see the CDA credit changes over time. So the ACV obviously has gone up, but in this particular case, because we have $1 million going into this and we've got 843 CDA, the difference of that, as I share with you, would be exposed to tax, but we end up with a net estate value, or the estate ends up with 925,000. On the 5% interest-bearing GIC, with the same amount of money being pumped in there every year, we know that the net estate value only runs to 477,875. So a relatively small number by contrast, but we know that it's exposed to tax. And so it's not a very efficient way to grow your assets in that regard. So let's answer the question, what would that investment need in order to compete with the life insurance solution? And so what we know is that the investment would actually need 13.13%. So unlucky 13. In this case, it needs a very high rate of return. And as I shared with you earlier, not only does it need that return, it needs that return every year for that entire strategy to play out. And so that becomes obviously a very significant challenge. 13% is very high, and quite frankly, probably unreasonable to assume that you would achieve that. But what it does is it helps this individual in their accountant understand that you would have to earn an unattainable interest rate in order to compete with this life insurance strategy. And so it becomes an effective way to communicate to the client the power of that life insurance. So again, highlighting that if we do show that 13.13%, which I like to do just to help the client see the value of the life insurance out towards life expectancy, you do end up having that same number. So if in fact your client believes they can get 13.13%, and they can do that for now until they pass, then they would actually equal the life insurance. And you can see that after life expectancy, the alternative investment would actually start to outperform the life insurance. But as we know, that's a very unrealistic expectation and not likely something that any client would believe there is a reasonable approach with. So A great way to explain this to the client and hopefully articulates to them the power of that life insurance within the corporation. So the third example that I wanted to highlight for you today loops back to my original opening remarks. And that's the idea of now using the universal life product, which is what we've used in the last two corporate examples, but using a universal life product that has vitality on it. And so in the previous example, it was very similar. We had the same age client, same tax rate, same initial death benefit. What's changed here, and you'll notice, is that there's a lower cost of insurance. So the cost of insurance is only $24,000. And the reason for that is because with Vitality, you can earn up to a 15% discount on your cost of insurance. So for that client who's 63, if they knew that they had the opportunity by living a healthy life and making some healthy decisions, they could earn a $2,000 or a little bit more than $2,000 savings on their cost of insurance every year. They might be quite interested in doing that. And in this particular case, what it also demonstrates is that it would actually provide them a 2% lift. And so you probably recall on the previous slide, it was 13.13% on the alternative investment. In this case, when the clients engage with Vitality, they've made those healthy decisions and they've been rewarded with a premium discount, it actually now requires them to earn 15.18% on that alternative investment. And so really powerful in that this interest rate is, quite frankly, like totally unattainable now, but it also demonstrates the power and the value of using a product like Manulife UL with Vitality. And so by providing this type of comparison to your client, you can also demonstrate that we do care about their well-being. We want them to live a longer, healthier life, and we will reward them substantially for doing that. So a really compelling offer here and something that I wanted to highlight in the presentation for you today. So again, if you look out towards life expectancy, which is where we always make these comparisons, you can see that very easily, if they were to earn that 15.18, the duration of this strategy would again equal the life insurance at life expectancy. And of course, if they were able to do it and they made it past life expectancy, this alternative solution would outperform it. So the message to the client is, do you think that it's realistic for you to earn 15.18%? And you'd have to do that obviously all the way past life expectancy in order to beat out the life insurance solution. The other thing that's interesting here, and again, it's beyond the scope of today's conversation, but even if this did play out in this regard, there would be other factors that would probably make this an unattractive solution, because as I mentioned, they may have a grind on their small business deduction because of the passive income that they're earning. So I hope that provides a clear picture of the corporate estate bond as well as the personal estate bond. As a summary, an estate bond can be shown personally or corporately. It's really just a presentation to help your client understand the benefits of permanent insurance, whether they're holding that themselves or in a corporation. It's an excellent comparison tool when comparing to an alternative investment that is taxable. So an important criteria there is that we are comparing this to an alternative investment that is taxable. We're not comparing it to an RRSP as an example. And it provides a powerful presentation that demonstrates life insurance can be a key tool to diversification and estate value optimization. So with that, I will stop sharing and I will pop back on here. And I think we had a couple of questions.
There is a couple of questions, and great job, Dan. So the first question we have is from Campoon, and the question is, do they have to add the deposit option during the application time?
It's a great question. I sense that question is just generally about Manulife PAR. So there's kind of two parts to the answer if it's not, but the answer is no. So if you're applying for Manulife PAR, you could actually illustrate deposit option as an example, and you wouldn't need to provide that deposit option in order to proceed with settling the policy, but it would provide you with that limit going forward that wouldn't expire. The other part to that question, which again, I'm not sure exactly how the question is being framed, but as an example, if they are talking about the concept itself, generally we do recommend that you, if you've illustrated it with overfunding, that you obviously execute that way, because that's how it was illustrated and that's what will lead to the better performance and ultimately outperforming. But I think, G, is your sense that that's just a general question about deposit option on par?
Yeah, I think that's more just a general question.
Yeah, so you don't you don't even have to illustrate it. We'll provide it to every client, even if you didn't illustrate it. But no matter what, illustrated or not, you also don't have to do the deposit option. It's tremendously flexible, and we don't hold your feet to the fire on that one. It's up to you to decide whether or not it makes sense for the client to use it at this time or not.
Perfect. Thanks, Dan. And the other two questions are kind of related. They're asking about one of the slides where you're dealing with 5 pools of capital, if they can get a copy. And the other one is, can you also send a copy of the presentation? So they're both related questions.
I will send a PDF over to you, G, and if you want to cascade that out to the attendees, that would be awesome. Does that
Perfect.
work?
Yeah, I'll share it with our marketing team, and then we can make sure that it gets out to everybody. There's no other questions at this time, Dan. So on behalf of IDC, we'd like to thank you for your time. We know it was a difficult session for you today. We appreciate you being with us, and we wish you a speedy recovery as well.
Excellent. Thanks so much, G. And just one last time, I'll just extend the invitation to anyone that was on the call. Please don't hesitate to reach out to your local wholesaler or to your local IDC counterpart, and they'll get you in touch. But we're here to support you, and we want you to do business with us, and we hope that we can make your life a little bit easier. So thanks again, and have a great day, everyone.
Perfect. Thanks so much, Dan. Have a great day, everybody.